Hey everyone, welcome back to the Living in Maryland channel where we discuss all things living here in the great state of Maryland. And crazy enough, we are already beginning 2026 here shortly. So wanted to create a quick video about what the real cost of buying a home here as we enter into 2026 is. So it's certainly not cheap, and wanted to go over kind of a breakdown of what to expect in raw cost. So of course you've got your down payment. So if you are someone who's going to be utilizing financing to purchase a home, which is most people out there, there's going to be whatever down payment for the financing that you choose to go with. But outside of that, the miscellaneous term is called closing costs. Closing costs are all other fees, all other money that is needed. Some of it's not fees, but all other money needed to acquire the property. So there are there's really six sections, six categories that make up closing costs. So those are going to be reimbursements. So this is money that the buyer is going to be reimbursing the seller for items that have been prepaid. So I'll kind of give an example of this as we move into there. The second form is going to be loan charges. So the second category is basically, your basic processing and underwriting. Any fees that are charged by the lender, if the buyer chooses to pay points are going to show up under loan charges. The third section is called impounds. Impounds is basically starting up your escrow account. An escrow account is a savings account that the consumer or the borrower rather starts with the lender, where they park money in that account so that the lender post-closing can pay all ongoing property taxes and insurance on behalf of the buyer. The lender wants to do this because they want to ensure that property taxes, especially property taxes, but also insurance gets paid. They want to make sure the home stays insured. They also want to make sure that those property taxes stay paid so that the county can't step in and force a tax sale if for some reason the borrower did not pay those property taxes. So you've got impounds. Next, you've got what's called transfer taxes, also known as government recording and transfer charges. These are taxes and fees charged by the state and the county that you buy in here in Maryland. Every county across the board in Maryland charges these, and of course the state charges at every level as well. The fifth category of closing costs is going to be title and settlement charges. So these are going to be some fees charged by the title company to go to the courthouse, pull abstract, pull all records to ensure that the buyer gets clean title at closing. That's very important for the buyer and the seller to ensure that there was a transaction there where the buyer inherited clean title from the seller. There's also your title policies, so an owner's title policy and a lender's policy, and then the final category of closing costs is going to be miscellaneous items. So, for example, if the property has an HOA or a condo, they're probably going to collect the next month of condo fee or the next month of HOA, just to ensure that gets paid at the settlement table, so the borrower doesn't have to worry about that for a month or two, or for whatever that term of the HOA is. Sometimes the HOA charges a fee or two, so maybe like $150 transfer fee in order to put that new HOA account into the borrower and out of the seller's name. So any like HOA setup fees, that's an example of a miscellaneous item, and we'll break all this down here in a little more detail. So I always tell people, for closing costs, you want to plan on about 4% of the sales price. And I know that could be a lot. I always hope it's closer to 3.5 or so, but 4% seems to be a good conservative marker to kind of gauge. So I'm going to use an example purchase price of $600,000 here today and give you a breakdown of exactly what to expect from closing costs. All right, so jumping back to that first category of reimbursements and proration. So again, as I mentioned, this is going to be money that the buyer is going to be reimbursing to the seller at the table. So it's going to show up as a cost to the buyer on the settlement sheet. So I gave the example of property taxes. The common prorations when you're buying a home is reimbursing the seller for any property taxes that they have prepaid. The other thing that is common is if there's any HOA or condo fees. So, of course, like usually the first of the month or the first of whatever the term for the HOA is, the seller is going to pay that, and that's going to pay in advance the HOA for whatever that term is. So then at the closing table, the borrower is going to reimburse them. So I'll give you a couple examples. So in Maryland, our property tax bills come out July 1. So what happens is when that bill comes out, that owner is going to pay the first installment of that bill. So normally the bill will come out July. So the first installment's going to be paid sometime in July. The second installment's going to be paid sometime in December for the through the end of June 30th to pay that full year of property taxes. So if you, in an example, if you were to close on a home in the beginning of September on September 1, the seller in July would have prepaid the taxes through the end of December, which is the first term. So that's going to leave 4 months. So if you close on September 1, that's going to leave all of September, October, November, and December that the seller has already paid the county in form of property taxes. So when you are taking ownership of that property and closing on the home on September 1, you're going to be reimbursing the seller for 4 months. So on an example purchase price of $600,000, property taxes are probably somewhere right in the range of $7,500. If we break that down, 4 months of property taxes is going to be $2,500. That's going to show up as an expense to the borrower and a credit to the seller. And just that's kind of how that works. Now that number can shift, of course, depending on when in the year that you close, and how much that needs to be reimbursed to the seller. So that's kind of an example of exactly how that would look like on a settlement sheet when you are buying a home in Maryland. Now the next one is going to be an HOA. So if the HOA is, whatever it is, a common one for most of your, detached homes, townhomes, it's a very reasonable HOA. So let's just say the HOA was $100 a month, right? If you're closing in the beginning of September, again, September 1, and let's just say maybe they have, or maybe you're closing on the 5th of September, right? Just for the HOA, for the sake of this example. The seller probably would have auto-paid the HOA on September 1st, so you're going to reimburse them for approximately 25 days worth of HOA. So that might look like something like $85 or something like that, right? That you're going to reimburse them, on the settlement sheet for an HOA that they've prepaid to the end of September. So when it comes to prorations, that's exactly what that looks like, and those are two common examples of what's going to show up on a settlement sheet and how prorations are broken down. All right, the second section of closing costs is going to be loan charges. So we're going to jump into this and give you examples of what to expect when it comes to loan charges. So first is going to be specifically processing and underwriting. Sometimes it shows up as usually under those names, but sometimes it's just called lender fees or whatever. But usually around $1,500 for the lender to process and underwrite the loan, get it from loan application all the way to loan closing. Now, I will say, not every lender in America is built the same. Everyone has, kind of different structures with this. Some charge less than others, some charge more than others. This is the average that I see that I always prepare buyers to expect. So when it comes to lenders' charges for processing and underwriting, right around $1,500 is kind of what I'm seeing. Next is they're going to charge you for your credit report. Most lenders that I see don't charge borrowers up front for a pre-approval and to look at their credit. They're going to do that with no cost to the consumer up front, and they're going to charge on the back end. So if it's a typical married couple, you're probably looking at around $100 for the credit report charged at closing. Next is going to be a flood certification. Those normally very nominal, $15 to $25 in order for them to pull a flood cert. Make sure that you're not in a FEMA flood zone. The lender just wants to know so that the consumer knows for sure, but also because if it isn't a flood zone, they're going to require that you have proper flood insurance. So there's that. Now, when it comes to prepaid interest, they are going to collect interest for the month that you close at the table as part of your closing costs. So the reason why your first payment is always 2 months after you close, or the reason why you always skip a month, is because they collect that prepaid interest at closing. So if you were to close anytime in September, just to stick with the example that we've been talking about, you're always going to skip October, and your first mortgage payment is going to be due November 1st. So the reason why that is because they're collecting prepaid interest for the month of September when you close on that home. Now, just to continue with our example of a $600,000 purchase price, I want to give you guys an example of what prepaid interest looks like. So if you were to close on September 1st, and you are buying a home for $600,000 and borrowing a mortgage amount of $575,000. So if you close on September 1st, you're collecting an entire month worth of prepaid interest for that month of September, because your first mortgage payment's not till November 1st. So almost what, 30-ish days of prepaid interest. So that's going to be right around $2,900 that they're collecting. That's going to be showing up as a cost on your settlement sheet, in form of prepaid interest. If you were to close on September 15th, okay, it's going to be roughly half of that. A little under $1,500 in form of prepaid interest, because they're just collecting from the 15th of September to the end of September in form of prepaid interest. And then your first payment is still going to be November 1st. You're always going to skip October in that scenario, but you're always going to skip the next month, and your payment's going to be due on the second month because of them collecting prepaid interest at the table. All right, next is going to be impounds and escrows. So this is where I was telling you guys where not all money is, that's needed to buy a home in form of closing costs is fees. Some of it is lender fees that we talked about. So that's definitely just a direct fee going to the lender. But some of it is just your own money that's just being collected and set aside for future expenses. Now, escrows is going to be one of those examples where you are just starting up an escrow account with the lender, which I always like to think about this as just a savings account that you're starting with the lender. And your escrow account is going to be paying all ongoing property taxes and insurance once you close on that home. So just to give you an example, now escrows are always going to be collecting homeowners insurance and collecting property taxes. So when you make your mortgage payment, once you close on the home, there's 4 things made up in that payment: principal and interest to the bank, property taxes, and homeowners insurance going into your escrow account. So if you had an annual premium from your insurance company to insure your home for $2,500, they're probably going to collect about 3 months of homeowners insurance and fund your escrow account with that at closing. 3 months of insurance is going to be $625 that they're going to park at closing in that escrow account. And then every month you make a payment, 1/12 of your homeowner's insurance premium is also going to be parked into that escrow account, so that the lender always has enough money to pay that insurance premium when the next term and the next premium comes due. So what the lender's going to do for property taxes, they're going to want to collect probably another 6 months of property taxes. That's going to be 10 months of property taxes, which again is very common for, it's a conservative number by most lenders to ensure that there's always enough money in there to pay ongoing property tax bills. And that's 10 months of property taxes is $6,250. And then when you add in some other things, prepaid interest, you can see how we're getting to thousands of dollars very, very quickly here in closing costs. So that's kind of, unfortunately, why 4% is kind of a good estimate. This is kind of where these things start stacking up very quickly. So again, I always tell people about 10 months of property taxes is what the lender's going to want to collect total. So if you're reimbursing the seller for 4, they're probably going to want to collect another 6 months to total the 10 months worth of taxes, again, to ensure that there's always enough money there to pay the next tax bill, because when that tax bill comes due, the lender's going to pay it because they want to make sure that those taxes stay current and stay due. And if there's not enough money, like some lenders will only collect 3 to 4 months, but then there's a higher likelihood of there potentially being a shortage in taxes if they don't collect enough and properly up front. And they're always going to come back to the consumer if there's a shortage. So if there's a shortage, they're just going to mail you a notice and tell you that they need you to mail them a check, or they're just going to increase your monthly payment. So it is important that these things get done correctly up front, although I do like to kind of put it out there that every lender does it a little differently. Some are a little more conservative, which I think 10 months is a little more on the conservative side. And I definitely see some lenders collect a little less, which of course make the numbers look a little more attractive up front. But sometimes I have seen that lead to a shortage where there's not enough money for those taxes, for the future taxes. And then that's going to create a situation where the lender's going to need to collect more money from the borrower in order to make up for that. So just something to be aware of, like especially when you're going through a pre-approval and you're looking at all these are things I can help my buyers kind of through and just make sure everything looks good up front. But again, this is kind of how these things go, and why you might, if you get a quote from lender A, why a quote from lender B might look a little different than lender A, especially when it comes to cash to close. You want to identify, okay, how are they collecting for impounds, for escrows, for reimbursements, and all these things, because it can definitely look, the numbers could look a little more attractive if they're not collecting as much money to pay for these things. So just something to be aware of when it comes to that. All right, next is going to be transfer taxes. Transfer taxes is unfortunately something that nobody can avoid, whether you're buying a home off the open market or whether you're doing a private sale. The state and the county is going to step in and tax every single real estate transaction. So let me break transfer taxes down for you really quick. It's usually just referred to as transfer taxes and everything's just bundled together. But let me break it down for you real quick into three different things. So you've got state transfer tax, county transfer tax, and county recordation tax. So one fee of transfer taxes is charged directly from the state of Maryland. The other two are going to be from the county that you buy in. So just something to be aware of. So when you break this down, there's one more. It's a minor fee, but $120 to the for the recordation fee to the county. So this is just for the title company to go and record the deed and the deed of trust once you close. So $120 for that. And then the rest of transfer taxes are those three things I mentioned: county transfer tax, county recordation tax, and state transfer tax. So just to give you an example, on a $600,000 purchase price, you got $1,500 for state transfer tax. You've got $1,500 for county recordation tax, and then the county transfer tax is usually the big one. That's going to be $3,750. And again, it adds up very quick, a little under $7,000 there, just for your transfer taxes. Believe it or not, the seller is going to be paying another almost $7,000. So they get, on an example purchase price of $600,000, they're going to get the total transaction for, what is that? A little over $13,000, which is pretty crazy. But again, it's built into the contract that the buyer pays 50%, the seller pays 50%, unless otherwise stated. So I would plan on splitting those equally, unless otherwise stated. So the only time that we saw it done any differently was during the COVID boom. Things have settled way down, but during the COVID boom, the market was so lopsided with so much demand and not enough supply. Some buyers were saying, Mr. and Mrs. Seller, I'll pay your portion of the transfer taxes, or a certain percentage of them, or a certain dollar amount of them, and that was increasing the buyer's cost in a situation like that. But that's not being done anymore. We're seeing those split 50-50 almost on every single deal now, and that's what I'm preparing buyers for when it comes to transfer taxes. All right, next are going to be title and settlement charges. So just going to walk you through this real quick. When it comes to a title company, this is something the buyer can select. So this is something that the buyer can shop, as well as your homeowner's insurance. There's not a whole lot that you can shop when it comes to, transfer taxes, or just they are what they are. But those two things specifically are things that you can shop for when it comes to time to get a contract on a home. Now, when it comes to title charges, I always kind of just wrap them in, because they're listed as like 5, 6, 7 different items, but really these are just title fees. Fees for the title company to go and pull all the records from the courthouse, from public record, that they need in order to issue clear title at closing. So you'll see like fees, abstract fees, title research fees, maybe some attorney fees on there. These are all just title fees for the title company to get all the info that they need in order to issue clear title. What does this look like in reality is when you bundle all those title fees together, somewhere in the range of $800 to $1,500. That's where you want to be in. If they're over that, it's too much. They're charging too much. But you really want to be on the lower side of that. You really want to be on the $1,000, $800 to $1,000. If they're charging over that, it starts to get, just a little pricier. They're just, in my opinion, they're just charging a little too much. So you want to be right in that range for those miscellaneous title fees. Then you've got a couple other title fees. You've got the owner's title policy, which is going to protect the owner. It's a one-time fee paid at closing in order to protect the owner from any future title issues. So you're going to inherit clean title at closing, but if something got processed wrong, if something got recorded wrong, or did not get recorded properly at the time of closing and popped up later, you have a policy that you've paid for that's going to protect you against any of those issues, and make that go away at zero expense to you. So that's an owner's title policy, highly, highly recommended, although not required for you to get a mortgage or buy the home. So it is optional, but it is something that we highly recommend, because when it comes to title, you just want to make sure you're protected when it comes to that. So something to consider, although that it is optional. If you are securing a mortgage to buy the property, what's not optional is a lender's title insurance policy. So the lender basically says, these are my words, but this is basically what they're saying. We are lending you the money, so we're going to make you purchase us a title policy to protect the lender if there is ever any title issues that popped up later. So very nice of them, of course, to do that. But anytime there's a loan, they're going to require the buyer to purchase a lender's title policy. So again, you can expect on a $600,000 purchase price, which we were using a $575 mortgage amount, you're looking at right around $2,000 for a lender policy. And then right around $1,900 for an owner's title policy. So you're pushing about $4,000 just in title policies there. And again, those are paid one time to protect the lender and to protect the owner in case of any future title defects. And then our last category here that I had mentioned is just a miscellaneous section. So if there are any miscellaneous items that need to be paid in order to for the buyer to close on the home, they're going to be listed here. So I had given you an example before of like an HOA transfer fee. So you might see that here. A lot of times the title company might collect a month or two of HOA just to kind of prepay those so that the buyer doesn't have to worry about that for a couple months. So if they do that, you'll see that here. If there's maybe the buyer is paying off a small debt in order to qualify or to make the numbers work, maybe that payoff is going to be shown here in the miscellaneous section. So anything miscellaneous, anything that's outside of the categories that I had listed here earlier is going to be shown in this miscellaneous section. So, I know that was kind of long-winded, but to wrap all this back up, I had mentioned about a 4% estimate. So if you take the purchase price, we're using 600 grand in this example, times 4%. So you got $24,000 in form of closing costs. When you wrap up everything I just mentioned, you should be hopefully in that $20,000 to $24,000 range. But again, the 4% is hopefully a little conservative. Some of these things they're percentage based, right? Every county is a little different. So I gave you transfer taxes for what they look like in like Howard County and Baltimore County. In Carroll County, they're a little less. You don't pay a county, one of the county transfer taxes. So it's going to lessen that, that amount for closing costs. And Arona County is a little more favorable when it comes to transfer taxes. So Prince George's County is more. So there's all these things that can differ depending on the county that you buy in, the price point that you buy in, and all these things. So that's why I like to give a range. But if you take the purchase price, times it by 4%, and then add that on to whatever your down payment is, that's going to give you a very, very, very close idea of what your total cash out of pocket is going to be in order to buy a home. If you ever have any questions, if you want me to walk this through with anyone as far as what this would look like for your exact situation, more than happy to do so. Of course, I'm not a lender, I'm a realtor, but I see these numbers a lot, helping people buy homes and go into closing and seeing all these things broken down. So I am fairly familiar with them. Although I like to disclose that I'm not a lender. The lenders kind of set these things in order to make sure that they're all correct at closing, but this is something that I see a lot. So, and just like to give people an idea before they start looking at homes, exactly what it would look like money-wise and out-of-pocket-wise in order to buy a home. So definitely not cheap here as we go into 2026, but this is exactly what it looks like if you have a goal of purchasing a home. We will see you at the next video, and thank you so much for joining us today.